Cost volume profit analysis is the cornerstone of management accounting. It allows managers to quickly determine the potential profitability or loss that they will make on sales. They do this by gathering the costs of manufacturing or providing their product or service, how much of their product or service they are planning on selling, and the price which they plan to sell their product or service for. An important component of the cost volume profit analysis is the break-even point. The break-even point is the point where total revenue equals total cost. That is, at which the company will neither have a profit or loss from selling the product or good that they are producing. If a company knows the point at which they break even, they'll also know then the point at which they will become profitable or could start to lose money. As we look this week at how to calculate break-even point in units or sales dollars, we'll see different factors that management can monitor to determine profitability or loss. For instance, it is helpful to know the number of units that must be sold in order to break even, which would also then be able to tell us the point at which we would become profitable, that is break even plus 1 unit, or have a loss, that would be break even minus 1 unit. We could also look at how reducing costs could increase profitability, or if rising costs would result in a loss, and how price adjustments would impact profitability. In other words, for every unit increase in price, how much would we profit? When we perform the break-even analysis, all of these factors will become clear. You'll remember we talked a lot about having inventory. When we do a cost volume profit analysis, it doesn't really factor inventory into the equation. They assume that all of the units we're producing are actually sold. Therefore, there's no ending inventory, and it assumes that the entire cost of producing a unit ends up on the income statement as an expense. If you think back to financial accounting, that would be equivalent of the cash basis of accounting. When we looked at income statements on the expense side of things, expenses are broken down according to manufacturing expenses and selling, general, and administrative expenses. In cost volume profit analysis, expenses are much less granular. We only look at it in terms of fixed and variable expenses. And what should be very familiar to us now are variable costs, which fluctuate depending on your level of production. That is, for every additional unit produced, your cost rises. So those include your direct materials, direct labor, variable overhead, and variable selling expenses. And some examples of that would be assembly line labor, physical material used in manufacturing the products, and sales commission. Fixed costs, the ones that don't fluctuate depending on the number of units produced, include fixed overhead. Example would be depreciation expense on your property, plant, and equipment, and fixed selling and administrative expenses. That might be the cost of operating the accounting department. Using this method of preparing an income statement based on the separation of costs into fixed and variable components is called the contribution margin income statement. This isn't used for financial reporting, it's only used internally for management accounting. Looking at this on a very basic level, you have sales minus the total variable cost, and that's direct materials, direct labor, the variable overhead, and the variable selling and general and administrative costs. That equals your total contribution margin. The total contribution margin minus the total fixed cost, that's the fixed overhead and the fixed SG&A costs, equals your operating income. So we see that the contribution margin is the difference between sales and variable expenses. It is the amount of sales revenue left over after the variable expenses are covered that can be used to contribute to fixed expense and operating income. Here's a pretty cool example of how cost volume profit analysis can be used in your own life. So you're going to buy a hybrid car, and leaving environmental concerns aside for a moment, you say that a hybrid car is more money than a regular old-fashioned gasoline vehicle. You want to know if your savings in gasoline over time is going to make up for the higher amount that you're paying for the car. So we have Carson going down to the Toyota dealership. He sees a Toyota Camry, and then he sees the hybrid version of it that's $3,500 more. He thinks that he'll drive approximately 12,000 miles per year, and that gasoline will average $2.50 per gallon. The example doesn't give us the difference in miles per gallon of the hybrid versus the regular gasoline vehicle, but it does tell us that Carson found out that he'll save $300 a year in fuel costs. If you just want to calculate it simply, you divide 300 by $2.50, and we'd see that it's 120 miles per year. But Carson did some basic math and said if the price difference is $3,500, he divided that by $300 a year. He thinks it'll take him about 11 and a half years to break even. If gas prices were $3.50 a gallon, then it would take 8.3 years. And we could figure that out ourselves. We saw that it's 120 miles per year difference between the hybrid and the regular gas vehicle. 120 miles times $3.50 per gallon. That's $420 a year savings. 3,500 divided by 420 gives us 8.3 years. So in your personal life, environmental concerns aside, you'd have to figure out, am I really going to have this car for the next 11 and a half or 8.3 years for it to be worth it? And this type of thinking can be applied to any situation where there might be a price difference between two similar options. In the next video, we'll look at a break-even analysis in terms of units of production.